morning, dosto, or if you're watching us later on in the afternoon or evening, then good afternoon or good evening. And obviously, with me is Sanjeev Gupta, CPA, and I'm Deepak Sharma. And we want to talk to you guys today about some important deadlines that are coming up this week. So we are recording this in the month of April. You might be watching a little bit later. We're in state of California today, and state of California had this weird thing about deadline this year, so everything is kind of a little bit off. But for most of you guys who are outside of California, deadlines are probably the same. So one of the major deadline that we need to really talk about right now is the IRA deadlines. So those of you guys who don't know about what IRAs can do for you, these are qualified plans offered by IRS that allows you to put away some money for your retirement, and you can put them so that way you can later on access those funds tax-free by having them in Roth. Similar to what you can do with your 401k, where you basically have put more money in your retirement plans, but you get a tax deduction on them right now, versus in Roth you take tax deduction. You don't take tax deduction, but all the growth is completely tax-free in future. So we're going to talk a little bit about that. What are the differences? What are the advantages? Why you should consider one? Why should you consider other? And let's just say if you don't have 401k, for example, maybe your employer doesn't offer that. Then what options do you have? If you are self-employed, maybe you drive Uber, maybe you're doing some sort of other gig. What kind of options do you have? So there are a lot of options. Government want us to save money for retirement, right? So that's the idea.
Yes, government wants to save money for retirement. Not only government, they want you, the taxpayer, to save money for retirement. The average retirement saving in the US is pathetic. It's $45,000 saving. Can you imagine that? $45,000 for a retirement life? How can that be possible? So that's why they want people, taxpayers, to save money in retirement. And like you rightly said, you can do Roth, you can do SAP, you can do Simple, you can do Solo 401k, defined benefit plan. You can do a lot of things. Even in California, we have a Cal Savers plan, which is given by the California state, and it's a plan which gives you some option. So yeah, we have a lot of options here.
So let's start out with very simple option. I think most people are familiar with it, so we'll start out with that, which is 401k plan, right? So 401k plans, like we said, allows you to put money for your retirement, and you get tax deduction today. That means you literally reduce your taxable income by putting your money in 401k,
so,
right?
Yeah, so we have in 401k, we have two types of 401k plan. We have a 401k pre-tax, which is traditional 401k plan, and then we have 401k Roth IRA plan. So we have both of those plans. Now, if you're age 50 plus, you can put $7,000 extra in addition to $20,000, like if you are age less than 50. There's a catch-up contribution also you can do if the plan of the company allows you to do that catch-up contributions. Now, like you rightly said, it's a 401k, it's a pre-tax money goes into retirement account. The options, investment option inside the 401k plans offered by the employers are very restrictive, because the retirement plan means you can do mutual funds, you can do ETFs, but you cannot do more stock. You cannot freely use that money in stock market. But again, the same concept. They don't want you to lose money in the stock market. But pre-tax money goes into 401k, traditional 401k, save taxes, whatever your tax rate, it saves money. After age 59 and up, if you take the money out, you pay taxes, ordinary taxes, because it's become ordinary income. After age 72, there's also RMD, required minimum distributions, which you have to take like 3%, around 3.25% of your 401k money. If you do 401k Roth IRA contribution, of course the money is after tax. You don't get a tax benefit. You can invest again in the same options, but you can grow the money tax free. If you leave the job, you can convert that to rollover to Roth IRA and use that money the way you want. Of course, there are certain rules for conversion. So you have to, if you are in a high tax bracket and you think you are making good money over a period of time, and you think you are well settled down with millions of dollars in their assets, then it's better to do balancing 401k retirement, 401k traditional 401k and 401k Roth IRA. That is always better. And also in 401k Roth IRA, the AGI limitation does not apply. So it's important to balance both the things and see where do you stand, how you stand, and what your goals are long term, and then plan accordingly.
So, just as a reminder, because Sanjeevji brought up this interesting thing about balancing act, I think what happens is oftentimes when we are kind of get used to certain tax brackets, we just don't think they will ever going to change. But the truth is, tax brackets are always changing. For example, a few years ago, we got this Jobs and Tax Act, right? What was that? Tax Cut and Jobs Act.
Jobs Act.
We had that act, and what it allowed us to do is reduce the taxable bracket for most of us. And people don't realize, but these brackets are going to expire in a couple of years, right? Sanjeevji, 2025, if I remember.
Yes, there are certain, always there are certain expiry provisions are there every year. Yeah, there are certain permanent provisions like child tax credit and other things. But yeah, the QBI deduction, which is for business owners, which is part of Tax Cuts and Jobs Act, and bonus depreciation, which is going down slowly. So those are certain provisions which we can see setting up if the IRS, if the government doesn't work, and if President Trump comes, who knows? It might be a permanent solution.
And the reason why I'm bringing that up is if you have substantial amount of your assets in a pre-tax money, you might want to consider rolling them over into Roth IRA, so that way you can take advantage of lower taxes today.
In case if you want to convert from pre-tax 401k to Roth IRA, you have to have less income. What's the tax bracket you want to do that? Should be less than 20%. If you do more than 20%, doesn't make sense to convert to Roth IRA. If it's because again you're paying higher taxes with the California state income taxes. So one has to really see if you're making losses, or you don't have much income, you're unemployed, or you're looking for work, or you have a lot of losses from business which can set off your income. Then in that year you can look for conversion. So you can plan. Again, planning becomes very important.
Yeah. So once again, what Sanjeevji is saying is basically you should look for opportunity, right? Look for those timings. Certain years when you don't have a high income, those are great years to do some conversion. You don't have to do all the conversion all at once. You can do small amount of conversions over the years. But keep that in your mind that every year when you have that lower tax bracket that you can take advantage of, use that year to do that conversion, because that can save you tons of money over the lifetime of your retirement plan. Now, Sanjeevji, not every company offers 401k plan, right? So if their company doesn't offer 401k plan, what options do they have?
Very good question. So if the company doesn't offer 401k, you're out of luck. Basically, you have to look at other ways of contributing retirement accounts. Other ways of contributing retirement accounts are traditional IRA, which is pre-tax money going into IRA, saves taxes. Amounts are limited up to 6,500. They are indexed to inflation every year. You can put the money in stock market and everything, but same rules applies like 401k. You can take money out only after age 59 and a half. If you take before age 59 and a half, you are subject to penalties. Federal penalty of 10%, 2.5% penalty for California. After the age 59 and a half, there's no penalties, but of course it's whatever money you take out is ordinary income. And there's also required minimum distribution after age 72. You have to take 3% of that RMDs. And if your beneficiary takes over your IRA, you die, something happens, and the beneficiary takes over your IRA, so they will take over your lifespan and do the distribution accordingly. So there's certain ifs and buts there's certain rules. Again, planning becomes important. And then when it comes, you can also invest in the Roth IRA. Now, Roth IRA is after tax money, same amount, 6,500, indexed to inflation every year. If you're age 50 plus, you can put additional $1,000 more. Yeah, you can do that, but there are AGI limitations. So if you're making more than 200k, married filing joint, you cannot contribute directly to Roth IRA. The other way around is to do a backdoor Roth, which is kind of a traditional IRA with pre-tax, after-tax money, and then converting the Roth IRA. And there's no AGI limitation. You are achieving same result, but you're doing backdoor, and you can get the best of both the worlds.
But the amount for that is still the same, 6,500 for
amount remains the same.
Right. So once again, just to clarify, if your company doesn't offer you 401k, then your option is that you set up an IRA account The limit for 2023 is 6,500. You can also contribute to Roth, where the limit is also 6,500. So you can have pre-tax funds in IRA account, post-tax funds in Roth IRA account. So far, I'm with you, Sanjeev.
Pre-tax in IRA, as long as your AGI limitation is there.
Right.
Like I said, AGI limitation plays a bigger role. So if you have more than 200K, you cannot put money into this IRA pre-tax. So it becomes after tax. Then you can convert to Roth. And backdoor will make sense because you cannot directly put money into Roth in the Roth IRA. So backdoor is the solution.
Yeah, when he says backdoor, what he's referring to is the logistics behind how you do this.
Yes.
Right. It's
because we file a form 8606 with your tax return. That's how people do it. So there's a form that tells the IRS that, hey, this is post-tax money. So when you take the money out, there's no taxes. So you file 8606 every year from the time you do a backdoor Roth.
Yeah, and people often, and this is very critical point, because I think a lot of you guys who are perhaps even doing your taxes on your own, or maybe you use a tax professional who doesn't do a lot of these conversions, what happens is you will go to somebody like me to set up that Roth IRA for you, and I'll tell you the procedure how to do it. We get that done, and then people forget about it. But the truth is that's not the end of it. There's another part to it, which is notifying IRS that you have done this conversion. Right. So you have to involve your tax professional with that. Make sure they properly file that form. Otherwise, that can result in penalties for you.
Yes.
All right. That takes me to the next question. Maybe your company offers you a 401k. What option does your spouse have? So if the spouse doesn't work, what can she do?
Yeah, so there's a spousal IRA, we call it, non-working spouse IRA. That amount, again, the same amount, $6,500 for non-working spouse. You can put that $6,500, higher AGI limitation. Okay, yes, you can do that for her. Or maybe you can start a business on the side, do a 1099 for moonlighting work. People do a lot of work outside the scope of their normal hours, working hours. And they do a 1099. They can open a corporation, the wife name, do a 1099, and also then contribute. Have set up a solo 401k plan, individual 401k plan for her, and she can contribute more. So again, planning becomes important. There are ways out other than not just putting 6,500 in spousal IRA.
So same rule applies as what we discussed before. If your company offers you 401k, take advantage of that. If your wife doesn't work, then you can go ahead and set up an IRA for her. $6,500 is the limit. You can also do Roth limited to your AGI. And obviously, if that limitation exists, you also have this backdoor Roth option where you can do some conversions later on to deal with that.
So a lot of time I've seen one more point I want to bring to the attention of people who are watching this video. A lot of times the company do provide 401k, but you don't involve into 401k, or you involve only to you contribute only to that extent where you get free money, free employer contribution to match that employer contribution. So 3% employer contribute, you put 3% only into the 401k plan. So remember, if you are in a bracket of 30%, 30% means husband, wife working in a California state, 250,000 or more. I think that's the average income in the California state. So if you make more than 250,000, your bracket is 30%. With federal and the state. So every dollar that you put into Roth into the 401k, you save 30 cents. Every dollar, 30 cents in a dollar. Where's the investment? What investment can provide 30 cents, 30% rate of return in the first year of contribution? Think that way. So always try to think about this. That you need to save money. Now, people do ask me this question: what happens if I have to go back to India or going back to country? Should I contribute? That's why I'm not contributing for 1K. The answer to that question is, even in India, we have a retirement plans. We have PPF accounts. We have other things. We still make those investments to save taxes in India. Same thing applies for US. Save taxes today. Now, when you go back to India, there are planning opportunities. You can do the conversion. You can either do a rollover IRA. You can do a conversion to Roth IRA. You can do a lot of the strategies that you can do. And moreover, important thing, you are involved into stock market or in the equity market or stock or mutual fund market of the US, and your investment is in dollar. Indian rupees is also sliding down. So remember, it's always makes sense whether you go back to India, don't go back to India, max out your 401k.
All right, so that brings me to the next question, and you briefly touched on it. What Sanjeev was saying is, look, if the spouse doesn't work, maybe she want to consider some sort of contracting opportunities, some sort of moonlighting work to generate some income. But that applies to all of us, right? Anybody who can start a business in US should start a business, and that business could be as simple as, like I said, being an Uber driver. It could be as simple as doing consulting work. Maybe you take care of the kids at home. Any kind of business, basically. Anything which has a motive of generating profit is defined as business by IRS. So if the motive is that you want to generate profit, you're in business. And if you're in business, that opens up a lot of opportunities for you. And one of those opportunities is you can do what we call solo 401k, right? So what is solo 401k, Sanjeev?
So solo 401k is an individual plan. Individual 401k, is a self-employed 401k plan. There's different names: solo 401k, self-employed 401k, individual 401k plan. So it's meant for one person, individual soul, one person having opening a corporation or a business. So a 1099 also qualifies as a business. So if you have a 1099 income, means you're not. What is 1099 income? You're working as a contractor. There's no withholding of taxes on your payroll. You get the full amount of check in your pocket. That's 1099. So when you get a 1099, or when you have a S corporation, you can set up a solo 401k plan, which is individual 401k plan. Now planning becomes important here. In case of individual 401k plan, individual 401 there are two types, two portions. One is employee portion, and second is employer portion. Employee portion is equal to like you working on a job, and you get a 401k contribution. You can max out 20,000. Now this year I think it's 23,000, and if you're age 50 plus, it's $30,000. So you can max out employee portion, and employer portion is based on the profit. In case of 1099, in case of S corporation, is based on payroll. In case of LLC, is based on net profit, because LLC, if it's a multi-member, you don't have to run payroll. If it's a single member, it's based on profit. It's disregarded entity. And if it's a C corporation, it's based on the payroll. So if you're one person one person owning it, there are no employees, you can do solo 401k plan, max out the employee portion and max out the employer portion, which is profit sharing portion, which can go up to 20% of profit, like I said, or 25% of payroll, like I said. So based upon that, you can max out. If you don't have profit, if you have a lot of expenses, you can still do the employee portion because it's not based on profit. So that's why it's so important. Planning from point of view, look at your total scenario, talk to your tax professional, make sure they do the right decision for you, and you max out your retirement accounts.
So the major difference between a regular 401k and solo 401k is that you have an opportunity to actually put more funds in your retirement plan, which more than likely your employer would not allow you to do, because they would not offer that profit sharing. More likely,
yes,
they could, but more than likely they
will not.
Right, but
unless it's your founder of the company, and yeah. So they cannot do solo 401k plan. They will do a 401k plan at the corporate level. They have a safe harbor 401k plan, which they do at the corporate level. So that's the plan they offer. They have to offer for that eligible employees.
So if you're if you're moonlighting, if you're a 1099 contractor, you have some sort of business, please look into solo 401k. If you need some help, definitely reach out to us, and we can definitely help you out with that as well. All right. So I think that answers questions for those of you guys who are self-employed. Let's moving on. Let's talk a little bit about strategies of catch-up contribution. So people who are 50 years or older. What do you recommend for them, Sanjeev?
You should do, like I said, you get $7,000 extra dollars. $7,000 you can put more towards retirement in case of 401k. In case of IRA, you can put additional $1,000. But max out that. Always look into that. If you're age 50, try to max out, because again you're coming into retirement age. 50 plus, they consider going towards retirement. It's not that you're retiring, but it goes towards the retirement. So you have to really look into and use that to the maximum. So if I were you, I will max out everything.
Yeah, and the younger you are, the more benefit you get out of it, because you have more opportunity to grow your money. So I always consider that, and I say this because so many times we meet with people and they don't even think about doing all these things like until they're in their 40s. which is fine. 40s is still good, but if you could do that in your 20s, that's even better.
Yeah,
right?
because you can do 401k, max out your contribution. Let's say you want to change the job, you can use the old 401k plan with the existing employer, with the old employer, previous employer, and do a rollover IRA. And then because your age is there, your 20s or 30s or 35s, you can use that money to invest in stock market, be aggressive in the stock market, generate more revenue. So you have options. So, but the starting point is you need to invest money to save money. So that's how it works.
Yeah, and Sanjeevji brought up another good point, and this is another perspective I hear. So many times people don't want to put their money in because of the fact they don't want to lose their money. So
in a way, they say that if I put money in a retirement account, anyway, I'm paying taxes right now. I will be paying taxes later on. But who knows what can happen, and who knows what other things you can do. A lot of business, you can start a business, you can invest in real estate, you can do a lot of other stuff in your life. So why you want to do all those things and without doing proper planning in the front, which is saving taxes. Today, if you are young, you are 25, 30s, 35s, you have no other ambition. Like, you don't want to start a business. Of course, you want to grow and prosper in your job or whatever things you are doing. So you should max out. That money is available in a bucket, and that money can grow, or use that money. There is self-directed IRA also. There is self-directed concept. Use that money to invest in business and real estate or whatnot. But money has to be there in the shell. You need to have something to play with. If you don't have anything, what will you play with?
Yeah, and the reason why I brought that question up, guys, is this. Oftentimes, all these things are the things that you might have heard from your friends, family members, or somebody just kind of said that to you. It's a great idea to reach out to professionals and kind of ask them, what are your options? I cannot tell you what to do. I'm not going to go tell you to go invest in Apple or invest in Netflix. I mean, that's your choice where you invest your money. But you should, at the very minimum, know what are your options. Hey, I'm a high risk investor. What can I do? I'm no risk investor. I don't want to take any risk. What are my options? I'm somewhere in the middle. What are my options? Should I put in 401k, IRA? Should I put it in Roth? What are my options? You got to know your options. That's all I'm suggesting. Just don't ignore it. Know your options, and then you decide what you want to do with it.
Yes.
So that's
start with saving money, and then growing money.
And then protecting money.
Then comes at the end to protect money.
So I'll leave this video at this thought with you guys. But as a reminder, a couple of things. Number one, we have an upcoming webinar coming up, which is going to be focused on real estate and FBAR. So please do join it. It's free, doesn't cost you anything. After that, we will have a live event coming out in July, where
August,
in the month of August. That's a live event. You can come there, where Sanjeevji will be talking about all sorts of strategies for reducing your taxable income. So that's a great one to learn. I mean, I've been going to that seminar for, I don't know, but 10 years, 12 years now, and every year I learn something new. So it's always a good idea to come to join that one. And at the end of the year, we will have our wonderful Life Summit, Wealth Summit, and that will be on, I think, on December 2nd this year. So that would be a great time. So please do plan on joining us on all of those events. And then we will have some in between. We'll let you guys know as they come along. So if you have any questions with the real estate, please go to our Facebook page and you can post them there, and I'll make sure I get those answers to you guys. I hope you guys find this video very, very helpful, and I hope you will save a lot of money for retirement, because we definitely don't want to be in that bucket for $40,000.
So again, like, saving is the first step, growing is the second step, protecting is the third step.
Yeah. All right, guys, thank you so much.